And welcome back to Dukascopy TV. I'm Monica Gibson. Bruno Estier joins me back once again in the studio. Together we're going to be looking at the chart from a technical point of view. Bruno, welcome back.
Good morning, Monica.
Nice to see you again, Bruno. Now, it has been a very volatile situation across the charts, across the markets over the last few weeks. What are we seeing now? Is it over yet?
Well, in fact, we have here a chart of the volatility VIX, and we have up there the S&P 500. And during the decline, especially last week, we had a huge spike at 31%, and this 31% has not been seen since 2011. So now, after this big spike, we are back at 16, so almost half the volatility levels, and we see that we are back to the blue line here, and that's a reversal which is quite important.
Okay, but what about in time where there's been a lot of talk about the kind of uptrend for the US equities? Is that in danger now?
Well, longer term, probably not yet. If we looked at the way it has performed over the last 2 years, we have apparently broken through the moving average 200 days. Here it's the moving average 40 weeks, around 1910. It moved down to 1820. From 2020 to 1820, that's about a 10% correction. So it's a relatively sizable correction we haven't seen for the last 2 years. And then it rebounded quickly above this moving average 40 weeks, and reaching the dotted red trend line that we see here. Also, on the way down, we noticed that here on the momentum oscillators, the oscillator is oversold and has crossed up. So it's probably a relatively important bottom that we are seeing here at 1820.
Okay, so what about this sort of rebound over the last few days? Is that sustainable?
The rebound is extremely sharp, as we can see here on the blow-up chart of the daily charts of the S&P. We went down in 5 days, and we went up about the same level in 5 days again. What have we done? We have retraced almost 60% of the whole move from 2020 to 1820, so we are now near 1943. Most likely, when something like that happens, there is some back-end filling. That means that at least we are looking for resistance around 1965, a little bit above the current price, where the cloud is located. And we can expect also some pullback, just taking 50% of this whole rise in the last 5 days. So that brings us to 1880. So we are in a range 1880-1965.
Okay. And if we talk about kind of the US small and mid caps, Bruno, is it the same situation we're seeing there?
Well, there we have here the small and mid cap. The small cap are on the top, the mid cap are here on the bottom, on the black line, and we have two other lines. The dotted red line is the relative strength of the small cap versus the S&P 500, and here down there the same thing for the mid cap as in a relative strength basis. And very clearly, this red dotted line is in a downtrend, and of course there was a little rebound, but we expect the remaining weeks until the end of the year to remain that downtrend to remain, and therefore we expect small and mid cap to underperform, and only large cap should be continuing to be the leadership.
Okay, so a bit of underperformance there, but what about in terms of Europe? What's the European situation looking like?
Well, Europe is not such a pretty picture. And worrying is a little bit this downtrend in the relative strength of the Euro Stoxx 50 versus the S&P 500. We see we were able to make new lows, and that's not a good sign. We broke some important trend lines. We made a spike similarly to the US market. The rebound is a little bit less. Of course, we do have an oversold situation and indication of further rebound, so we can envision a trading range between 3,100 and 2,900, but there are some risks to revisit this spike low, possibly even on a closing basis. So that's less a good picture.
Okay, so not a particularly pretty picture you said about Europe, but is there any help for emerging markets, for example?
Emerging markets have been not too helpful. At least they were not worsening the big pictures. And we see that here in the relative strength of emerging market versus S&P 500, even during the decline, and despite the fact that emerging markets are more volatile than the S&P 500, the relative strength has been holding flat, about flat. So that's relatively a good news, but they are not helping yet. They are not leading anymore. So all eyes are basically closed on the S&P 500 and maybe some other markets.
Okay. What about EM's not helping the picture, but what about Japan? Is that still in danger, or?
Well, Japan was a special case. It used to be outperforming all the way until the last 3 weeks. We see that here on the top part of the charts. We have the dotted line, which was the rising relative strength of the Nikkei versus the Euro stocks here. And in the last 3 weeks, it has pulled back a little bit. So it's not the best performing market anymore. Fortunately, the market moved from 16,300, which was the top resistance, to basically the bottom part of the range, which is given by the rising blue trend line here and the clouds around 15,800. So as our oscillators are also oversold, we can expect a rebound, but no big leadership as we used to have in the past, during the past months of August.
Okay, so even the safe havens are not really, just all eyes on the US then?
So all of the eyes are really on the US, and we need to follow that carefully.
Okay, excellent. Well, Bruno, thank you for coming in and giving us the latest update. It's been a pleasure once again. Thank you.
You're welcome.
Okay, well that's all from Bruno and myself for another episode, but please do make sure you keep clicking back to Dukascopy TV for the hourly updates. Goodbye for now.